In today's video, we're going to take a look at innovative industrial properties, ticker IIPR. It's a pretty common request because it was one of the fastest growing REITs during the pandemic, whereas today it now offers a yield of around 8%. Given the nature of this company, I'm also going to have to disguise some of the words that I use to describe it. YouTube can be kind of sketchy nowadays in terms of what you're allowed to say and what you're not. But Innovative Industrial Properties is a company that's focused on the acquisition, ownership, and management of specialized properties that are leased to state-licensed businesses for the production of medical use hash products. They're currently one of only a small handful of these REITs that own these specific types of properties. As of the making of this video, this company currently has 111 properties in their portfolio across 19 different US states. This gives them a combined total of roughly 8.3 million rentable square feet. They're also a triple net lease REIT, which means the tenants are responsible for covering all of the property's expenses. It's a really ideal structure since it saves REITs a lot of money, and nearly all the best REITs out there, including Realty Income and W Carey, operate this way. They tout some really impressive results in their latest investor presentation. You can see how much they've grown over the last few years in terms of the number of properties they own, as well as capital committed, the number of tenants, and how many states they now operate in. The weighted average lease length for their tenants is about 15.5 years, which is really good. The longer the average lease term, the more predictable rental income will be. You always want to lock in tenants for as long as you possibly can. They've also seen an insane amount of growth in net operating income, funds from operation, and adjusted funds from operation, all of which are really crucial metrics for REITs. On top of all this, over the years, their stock has also increased their dividend distributions a lot. Originally paying 15 cents per share back in 2017, today their stock now pays $1.80 per share in quarterly dividends. That's a huge amount of growth in just the last 5 years, which is pretty unmatched by any other dividend stock I've come across. To date, they've never reduced their dividend in their company's history. Seeking Alpha's bar chart that I normally show in these videos doesn't appear to have this correct information, as it's showing some dividend cuts that never actually happened for some reason. So with all this good news, what explains this stock's share price performance over the last year? Just by looking at IIPR's one-year share price performance, we can see it's dropped by more than 53%. The stock reached an all-time high back in November of 2021 at around $280 a share, whereas now it's currently trading for about $91 per share. So it's lost more than 2/3 of its value since peaking in November of 2021. The reason for this has to do with the huge boom in medical and recreational grass sales between 2020 and 2021. A mixture of different factors including the pandemic lockdowns, more states legalizing the stuff, and I think just investor sentiment about this growing industry caused the share price for this company and others like it to soar. During this time, it was relatively easy for them to find investors willing to put in money. But when 2022 started and we entered a bear market, the more speculative picks like tech, crypto, and herb companies suffered much more than average. But Innovative Industrial Properties has been facing their own challenges over the past few months, which have been reflecting in their stock's share price performance. Despite having an occupancy rating of 100%, not all of their tenants are currently paying rent. On January 18th, the company released a statement in which they announced that they would only be able to collect rent from 92% of their properties for the month ending January 31st of 2023. This obviously creates some huge concerns, which caused their stock share price to fall almost 17% in one day. One of the companies failing to pay their rent is Parallel, which is a nationwide brand of grass. Parallel is IIPR's second largest tenant, who currently occupy 8.7% of their total portfolio. Green Peak Industries and another smaller tenant by the name of Medical Investor Holdings LLC have also got at least one building they're currently in default with, which obviously isn't good. A 100% occupancy rating is meaningless if you're not collecting the rent from all of your tenants. In that situation, it'd actually be much better to have a 92% occupancy rating so at least a different client would be able to rent out their properties. A slight or even a moderate decrease in rent collection doesn't always translate into immediate doom though. There were a lot of REITs that saw poor rent collection numbers throughout 2020 and the majority of them were able to make it through. But on the other hand, this industry has been seeing a lot of good news as Americans' perspective on recreational Mary Jane has been shifting a lot in recent years, which does show this sector has a ton of growth potential. According to Pew Research, 88% of US Americans believe the stuff should be made legal under certain situations or completely legalized altogether. As of January of 2023, 21 states currently have the stuff legalized for recreational use for people over the age of 21. For medical purposes, it's currently legalized in 37 states, with people in virtually every other state trying to get it allowed. In terms of growth, according to Cohen and Company, they estimate that by the year 2030, this industry could see annual sales in excess of $100 billion US. The number of jobs this sector supports continues to grow year over year and creates an estimated 280 jobs every single day. But while trends like these are really encouraging for people who invest in these kinds of stocks, there is one crucial metric that I think can have a really negative impact on companies like IIPR. The growing demand for this stuff has also resulted in prices being compressed significantly. According to BSDA, the retail price of these hash products has been going down due to more competition within the market. Between 2021 and 2022, the price of retail hash products fell by roughly 20%, which is undeniably a huge decrease. As more of these dispensaries and retail stores pop up, these businesses are only going to see an increased amount of competition, which is already leading to price declines and lower profit margins. But on top of that, we now also have to ask a really important question, which is how are the sales of this stuff going to be impacted by a recession? The fact is, this industry is not recession-proof. Although people use this stuff for medical purposes, it is an item that people can go without if necessary. I've seen people compare hash to alcohol, and I've seen that people have pointed out the fact that alcohol sales actually went up during the 2008 financial crisis. But I think there's a few key facts that people are overlooking when they make this comparison. First, although there continues to be a lot of debate on whether or not hash is really addictive, what's not up for debate is the fact that alcohol dependency is a real thing. Tragically, during rough times when people are strapped for cash, some people are going to continue to buy alcohol due to an addiction, and we've seen that happen during harder economic conditions. Secondly, growing your own hash is still a really popular alternative to buying it. Growing it yourself is a really easy thing to do, and although it does take time, if people are going to be short on cash, they will do this over going to a retail store and buying it. A lot of the retail companies that IIPR leases their warehouses to advertise their hash as being premium and high quality. They make pre-rolls, drinks, edibles, capsules, and all these other types of products. But at the end of the day, people who want to get high on a shoestring budget are either going to grow their own or they're going to get it off the streets. Hash on the black market is a relatively inexpensive purchase, but if you've ever been inside a dispensary or visited one of their websites, you might be in for a bit of a sticker shock. Buying just a couple grams of this stuff in a retail store can cost you well over $50 a pop. The reason for this is because this industry is very heavily taxed. It was one of the selling points made by advocates trying to get it legalized, and it helps fund the black market sales of this stuff to this day. But ultimately, nobody knows for certain the serious impacts of a recession on retail pot sales, because nobody's ever seen this before. But now let's take a look at this company's financials. As we saw earlier in their latest investor presentation, this company's been going through a lot of really impressive growth over the years. Starting with adjusted funds from operation, which takes funds from operation and includes rent increases and subtracts maintenance and capital expenditures, we can see it continues to move upwards every quarter. Their most recent quarter, though, didn't see any growth, which is different compared to every other previous quarter in this company's history. $60 million last quarter was reported, whereas the previous quarter they also reported $60 million in AFFO. This could be the result of some of their tenants not paying their rent, or it could be the company hasn't been acquiring new buildings as of recently. Under expenses, there's another concerning issue, which is despite collecting an identical amount of rent to the previous quarter, property expenses keep increasing, and so does selling general and administrative expenses. It's not a significant amount of growth, but you can see the issue this company could have in the future. If they're not collecting all their rent money and expenses keep growing, then that dividend isn't going to be safe in the future. Seeking Alpha is also reporting that this stock's FFO payout ratio, which is different from a normal stock's payout ratio, is at 92.33%. For REITs, when calculating the payout ratio, you don't use net income, but rather FFO or AFFO because it's a much more reliable metric for REITs. This number is always high because REITs are required to pay out 90% of their earnings to shareholders in the form of dividends, so it's not particularly rare to see a metric this high. But we can see that its current payout ratio is currently the highest in this company's history. But in summary, based upon what we've looked at, I'm seeing some mixed signals going on. Although the company does have a really great track record of really excellent growth for the last few years, their most recent financial reports are showing some bad signs. When taking their announcement about rent collection into consideration, I think this makes innovative industrial properties a particularly risky investment right now. And remember, the grass industry is by nature riskier than others because you also have to worry about legislation and unique tax circumstances. On one hand, the demand for these products is expected to keep soaring, but it's also leading to less profits for these dispensaries. Plus, we don't know how this industry is going to react to a recession. It's not a stock that I own, but I continue to watch. But like I said, their latest financials do have me concerned a little bit. If rent's not collected from more of their tenants, then this dividend can't be considered safe. I do hope we'll see better improvements in their financials during the next quarter, though.